everybody. Yeah, thank you, Mark, for asking me to participate in this. I really took a lot from the convention where Andy was talking about build a business, not just a book. I'm a corporate sponsor for a group in my area called Helping Seniors, and they're the ones that have had their hand on my back with regard to podcasts and YouTube videos and that kind of thing. And their motto is, don't put your head in the sand, have an aging plan. And so my goal is to really, in light of all of the expertise that we have at NAIS with all the Medicare agents and the specialty, is to talk about how we can not just have a policy, not just a Medicare policy, not just a Medicare supplement, not just policies, but let's talk about a bigger picture and have a plan that's comprehensive, with the goal being a resource, being a trusted advisor, not just an agent coming in to write a piece of business. The truth of the matter is that we with the 215 license, and many people have other licenses as well. I don't. We have we know a lot more than people that we sit with every day, and they don't know what they don't know, and so it's our job to really fill in the gaps and say these are your options. When I've got my license in 2014, I'm pretty new in this. I started out doing life insurance and annuities, and I really didn't have my head around annuities at all until I wrote one for myself, kind of figured out kind of how it worked. But I remember one of my first 2 appointments for life insurance, there were leads that I drew back in the day when we would meet with people in person. I drove a long way, and I showed them all the different things that they could get, and they both said, oh, by the way, we want that annuity. And I'm like, what? So one of the neat things about what we do is that we can show people different ways to protect the risk. And I love what Mark shared about make it their idea. And I loved his comment about generational relationships. As I was getting ready for this, I realized that a lot of people with North American don't even know much about me. We know who each other is, but this is my family. This is a picture I use when I do interviews on long-term care to say, when I ask them, what are you protecting? I say, this is what I'm protecting with my long-term care plan, with my aging plan. I don't want my granddaughters to be the ones that are taking care of me. My husband passed away from pancreatic cancer almost 7 years ago. And so I share that he's not in this picture, and I share that I have been a caregiver. So I come to the conversation of long-term care, not just Medicare, with an authentic experience about what it's like to be a caregiver. I am endorsed by Dave Ramsey, which is a really great thing, because Dave Ramsey tells his people who are in their planning stages, as part of your plan, you need to have a long-term care policy. And so that really gives me a lot of people to meet with and talk with. My resident license is in Florida, but he's got me working in Wisconsin, Ohio, Michigan, and Pennsylvania. I have licenses in other states. But the great news is that a lot of the companies that we work with, Aetna, Manhattan Life, Willoughby, those strategies are in those states. I don't have any of those options in Florida. So I'm hoping that the Insurance Commission will get their act together and bring those strategies to Florida. When we talk about the risks, Mark shared, we have a number of risks, and I love what he said. He said, let's make it their idea. But we have to really educate on what the risks are. Many people make assumptions. The first risk is that we assume that Medicare pays for everything. Medicare does not pay for long-term care. Medicare will pay for, and this is in the weeds, kind of a nuance, but Medicare will pay for it'll pay for skilled nursing if you've been hospitalized for 3 consecutive midnights, and that's in admission, not observation. If that's number one. If number 2 is if you go from the hospital directly to skilled nursing. And number 3, as long as you're improving, they will continue to pay. What I've heard is, and I haven't seen this on the CMS documentation, but I've heard a lot of conversations about it both ways, and even litigation, that if you stop getting better, they're going to stop paying. So there is a risk to trust Medicare even for those first 100 days. Medicare does not pay for assisted living, and Medicare does not pay for nursing facilities. Home care. The next risk is longevity. I bet you've never heard that longevity is a risk to our planning and our portfolio. But the truth is that we are living longer because of technology and because of pharmaceuticals. And when we live longer, we may not live better. We may still need more care the longer we live, assistance with activities of daily living. So one of the things I want to share with you is some of the tools I use. This is a quoting tool from Securian, and this is kind of creepy to think about how long are you going to live. When you ask your clients, how long do you think you're going to live? It's kind of a funny conversation, but my background's in litigation, and when we would prepare a lawsuit for a settlement demand, we would want to figure out what the actuaries say about how long is this person going to live, and that's really how we would design our settlement demand. So in this particular case, a male, 66 years old, is expected to live to age 90.13. And a female, age 66, is expected to live till age 93.62. Again, we don't know for sure, but that's what the actuary science says. The next risk is waiting too long. And if you've done long-term care, you guys have been doing this longer than me in most cases, but the biggest hurdle that we have is underwriting. We don't get to pick if the insurance company is going to take our application. The insurance company gets to pick. So you all have your stories. I had an example of some friends, clients. I met with them last year. She went on Medicare. They would probably have been perfect applicants for a long-term care policy, but they wanted to wait. He got diagnosed with pancreatic cancer last week. So we can never assume that we're going to be eligible tomorrow. And of course, we know that the cost is going to only increase as we get older. The next assumption is not understanding the risk. And again, this is just a number. This is a tool. I use a lot of tools. I use the Securian calculator for actuary science. I use Buddy-ins. If you're not connected with Buddy-ins, you are missing out. There's so much good stuff there. But what they say is that 70% of Americans over the age of 65 are going to need some time of, I like to say, assistance with activities of daily living. And just so you know, some of these slides are some of the ones I use in my interviews with people, just because it helps educate. And I feel like that's probably my first role, is to educate. I think we got this from Sean a while ago, but this is from the Academy of Elder Law Attorneys. There's a 1 in 1,200 chance that my house is going to burn down. There's a 5 in 1,200 chance that my car is going to be totaled. There's a 105 in 1,200 chance that I'm going to be in the hospital. And there's an 840 in 1,200 chance that I'm going to need some type of, not long-term care, but assistance with activities of daily living, right? So no, I'm not going to cancel my homeowner's insurance because the odds are low, and I'm going to keep my car insurance because I have to, and I'm going to keep my health insurance just in case. But how many of us, especially the baby boomers, aging into baby booming resources, do not have some type of a plan? Let's see. And the next risk is the idea that and Mark made reference to this too, I'm going to just pay for this myself, the self-funding conversation. So that's a great idea if you have lots and lots and lots of money. But Dave Ramsey has lots and lots and lots of money, and he says to get it. And Clark Howard, he says if you've got 6 million or more and you're living off the interest, you could probably get away with not having a plan. But the point is, most people today don't have those things we call pensions that are lifetime income. They have a 401k. Generally, their 401k is in the market, and it has potential market risk. So if you've got, first of all, $1 million in your 401k, you don't really have $1 million. You've got 750 because the IRS is going to want to take theirs, right? RMD. Relying strictly on your investments to protect this risk is a very precarious strategy. We have a cost of care calculator. It's from Genworth. I don't know how current it is, but this is something that I use. I share with my clients. The cost of care is expected. We're not talking about the cost of care today. We know that it's about $10,000 a month. But what we want to look at is what's the cost of care going to be in 20 years, 30 years, if that's the age space of your client. Not only what's the cost of care, but how many other people are going to be demanding those resources. So supply and demand, the cost is going to go up. Homemaker service, home health aid, $12,000 a month, down to a semi-private room. $20,000 a month in a facility. This is another tool I get from Back9. Back9's amazing. If you haven't used their tools, yay, Claude, it's amazing. Thank you so much. I want to start at the bottom of this. This is a worksheet that you can actually generate by putting your names, your ages. It's a tool. I tell my clients, this is just a tool. It's not perfect science. There's a chance you could die tomorrow and not need anything. But if we start at the bottom of this, going back to the life expectancy for Patty, she's expected to live till age 92. And the tool says that the median age for someone her age is to go on claim about age 84. So right there, we're looking at 8 years potentially that she might need care. The next one is Steve, 83, life expectancy is 90. So right there, you're letting your clients figure it out that we've got to protect a significant amount of time and resources to protect that potential risk that's in our portfolio. The next part of this is the probability that at least one of them is going to need care. 77%, bingo, right there. I have so many clients zoom in on that and I let them figure it out. Yep, at least one of us is going to need this. And so that's a really great opportunity to design a policy with a shared care rider. That way they feel like they're being efficient with their money. And at least one of them potentially is going to use the policy. And they're really understanding that they're doing a really good job at protecting the risk. And then the tool in this particular case says that there's an 80% probability that together they're going to spend $1,200,000. And you look at that and you say, no way, no, that's not possible. But when I back it out and I think about the fact that my mother-in-law was in memory care for 9 years, we paid $980,000 for that care, and she died 3 years ago. So that was yesterday's cost of care. That's just one person who had longevity. So in reality, this projection looking forward, it could be quite modest for somebody who's got longevity in their family and in their life. Is everybody with me? I can't see you. Y'all there?
Here. Everybody's still
okay.
here.
Yeah. Okay, thank you. I can
you
either see you or my screen.
Lori. They're riveted.
Okay, I can either see you or my screen, and I can't wing it. So the next conversation I like to talk to people when we talk about self-funding is the impoverished spouse. We're going to self-fund this risk. He gets sick. He uses all the money for his care. He passes away. She's left without a spouse. She's left without any money, and she's left without a policy. So that is a worst case scenario, but many people assume, of course, that Medicare is going to pay for their care. No, what they're thinking or confusing is Medicaid. Again, Buddy Inns has an amazing training on what Medicaid will cover. And so I also participate in some other trainings from some people that do crisis Medicaid planning because I really want to understand what's involved in that conversation. But in order to be eligible for welfare, right, aid for the poor, Medicaid, you have to spend everything that's highlighted on the right-hand side. Financial advisors, call us sometimes and they say, my clients, she called, her husband's going into a nursing home. She's concerned about her assets. What do we do? And what she can do is, if they don't have a policy, is she can keep one house up to, and I think they said around 800,000, one car. So if they've got 2 cars, they can sell them both, and she can get a nice car because that's probably going to be the last car that she gets. Then she has to use all the rest of their own assets, spending down to leave him $2,000. Now she can keep 50% of their joint assets up to a ceiling of $154,140. So that means and that includes a prenup. So that's something that was startling to me. If she comes to the marriage with with money from a prenup, the government's going to count that. Wow. I've got a client, she had $1 million settlement, and she really kind of perked up when she found out that if her new husband needed care, in order for him to get care from the government, she's going to have to spend her money first because they got married. Which is why I don't know who said this, why a lot of 80-year-olds are shacking up and not getting married, right? In any event, he's got to spend down $343,860 of their own money before he's even eligible to apply for Title IX and get a Medicaid benefit. So the strategies, I'm going to bring it back to the Medicare conversation, because that's where a lot of us live. I know we're here to be resources. We're here to help our clients. I really, I appreciate my clients. They get a cookie on their birthday every year from me. But I want to be sure that we're talking about the risk. And this is something we talked about at the convention. Stephen did a really great job with the bundling conversation. But yeah, if your client doesn't want to supplement and they've got an advantage plan and they've got these exposures, let's get him a hospital indemnity, because right here, this is an example of a plan I pulled up this morning. This is Humana, $305 a day for the first 7 days out of pocket. That's huge. The other part that I never focused on until I really started working in the long-term care space is the coinsurance for skilled nursing. Yes, if you have a supplement, it will pay for the first 100 days if you met those other criteria we talked about. However, if you've got an advantage plan, you're going to pay around $200, give or take, a day for day 21 through 100. Now, the next thing I found is going to be startling, because with Aetna, you can get a policy that has skilled nursing, $500 a day for day 20, 21 through 100. It's only $22. Are you kidding me? That's kind of a no-brainer, right? This whole policy, I think, is less than $80. But by the way, you can get a cancer policy, another risk, $20,000 cancer policy for $27. So use your hospital indemnity, fill those gaps, figure out ways to really protect your client, and I promise you, they will love you. We know we can't meet with a Medicare client and talk about long-term care and short-term care, and we can talk about indemnity. But when we've planted the seeds of the gaps and the risk, we can say, oh, by the way, these are some of these are like, I like to think of this as a menu or an option. I love it. Something else Stephen said at the convention is many people are walking away from a work plan and they're paying $1,000 a month for their health insurance bundle. And we come in and assume that they don't have any money to spend. No, that's not true. They want to have protection. They want to allocate their resources in the most efficient way possible to have as much comprehensive benefit as possible. So don't be shy. Show them the OmniFlex. Show them a traditional long-term care policy. Show them a final expense. Andy did a great call last week about using Back 9, going in and getting those quotes for a Mutual of Omaha final expense. Where does that show up? It's not just a funeral expense. It's when one spouse dies, the other spouse loses part of their income. One Social Security check goes away. What about selling a house? There's things that you have to do to get that house ready that costs money. So, and I was trained, by the way, to always add an accidental death policy because they're super cheap. You never know. My dad died from an accident. He fell. Yes, he was 84, but he did not die from an illness. He died from an accident. So talk about all of those ways that you can help protect your clients. When I talk to my clients in my interview, now I'm not one of those one close wonders. I know a lot of the specialists I work with are, but I let my clients marinate with their quotes. And I tell them, these are your options. I'm going to send these to you. We're going to come back another day and you tell me how you want me to help you. Takes the pressure off. They're not feeling like anyone's hustling them. But I tell them we've got traditional comprehensive, we've got asset-based hybrid, we've got short-term care, extended care, we've got these other strategies. And then I show them this worksheet. Now this takes work, but if I want to make money, I'm willing to work. And so far I've been doing pretty good. I guess, are you happy with my work, Mark? I show them whatever they're eligible for. I show them whatever they're eligible for. In most cases, I take National Guardian Life off the chart because it only will cover preferred applicants. But what this chart and this worksheet does for me, and you can create your own and let me know, I can help you with it. It's pretty easy if you've got access to all the quoting tools, is I show them side by side, apples to apples, what they're going to get and what it's going to cost. And this is the reason I guess I'm number 3 with Manhattan Life. Because people figure out that cost versus value, you're getting a lot of value by just getting the cash for care plan and not paying for all those other things that come with the policy. Now, some of those other things are really important to people and they make sense to people. They make sense if you want to do the shared care. They make sense if you want to do a 10 pay. They make sense if you want to have some of the benefits that go with like home modification and care coordination. Those things have value and they make sense. But it's not my job to figure out what makes sense for you. It's your job to figure out what makes sense for you. I let you know what it is, and then you come back and tell me what you want. But by the way, one of the things that's happened for me in the past 6 weeks that I just want to give attention to, because I've kind of been sleeping on it, is I tell my clients when I tell them, here's your options. I say, you've got traditional comprehensive, you've got asset-based hybrid, you've got short-term care, extended care, life insurance with a long-term care rider. And we also have, I tell them, we also have annuities that, it's completely safe. They're fixed index annuities, but you can actually leverage dollars for long-term care. I don't have anything to show you today on that, Mr. and Mrs. Goldberg, but if you'd like to see it later, I can definitely show you later. I have had so many people come back to me and say, before we decide on these other options, we want to see what the fixed index annuity with the long-term care rider looks like. I'm like, great, let's take a look at it. So I told Mark this morning, I've got between 800 and a million million and premium pending on some fixed index annuities that have long-term care riders. So I want to just show you real quick what that looks like. And most of you probably have done this longer than me. I've only been doing it for 10 years. But if you haven't and the word annuity scares you, just forget it. It's easy. An annuity is an account with an insurance company that pays interest and has other benefits. Do the training and talk to somebody, look at as Steven says, look at the brochure. They're really great options to protect some of the risk that we have that's in the market. First of all, there's no risk for market loss. You're never going to lose anything again. We call it sleep insurance. The next thing is it's indexed to the market, so you still have market growth. The next thing, and one of the reasons these couples came back to me and said, we want to see that, is there's no medical underwriting, none. It's amazing that we can get this for people that couldn't otherwise qualify for a traditional comprehensive plan or even a hybrid. There are multiple indexing strategies. If you've got clients over the age of 59 and a half, they can pivot from their 401k to an IRA without any fees and without any taxes, because we're moving it from one qualified account to another qualified account. An example of one I did I'm working on with a lady, 200,000. She's taking it from her 401k. She's going to put it into an IRA with a long-term care rider. When she's 81, okay, remember, she's only putting in 200,000. If she needs long-term care, she'll get $209,000 a year for 5 years. On the other hand, if she doesn't need long-term care, it's always still her money. She's never let go of her money. But if she doesn't need long-term care, and if she passes when she's 81, her 200,000 just became 838,000. So it's a really, really efficient way to help people. And you don't want to take all their money. You want to keep some of their money in the market. Assets under management, keep it growing, but protect some of it. It's just a great, great strategy all the way around.
Hey, Lori.
And this is, yeah.
Quick question. Are most of those annuities that have long-term care features you can hold in an IRA? I didn't think you could.
Yes.
Oh,
I don't know about, I'm not going to say most of them, but yeah, you can use qualified money. Now it's going to come out. You haven't paid taxes on it yet, so you still have to pay taxes on it. But yeah.
Oh, so no, that's not what I was asking. Can an IRA hold one of those annuities that have, meaning you're not pulling money out of the IRA to pay for it? It's held in the IRA, and I'm not sure you can do that. You understand what I'm saying?
So I can tell you what I'm doing. I'm moving 401k money into an IRA. But if you're talking about an IRA that already exists, that I'm not sure how you would structure that. I'm not sure how you would do that.
Lori,
Claude, you probably know that.
Sharon, you can do that with the One America product. Talk to Keith Burton about it. You can
well,
use
that's what I'm
money.
showing you here. So this is One America's. This is taking qualified money from a 401k. You're going to get a 25% bonus. If you move 200,000, you're going to get a $50,000 bonus on the benefit base. your $200,000 becomes a $732,000 long-term care benefit. And the way you buy the long-term care policy is there's a distribution. It's a 1099-R at the end of every year to so you're not paying taxes all at once. So I don't know if that answers your question. So
Well,
never, 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 never. I'm kind of being silly. Never talk about nursing home insurance. Because the last thing you want people to have in their mind is being old and decrepit. In fact, you've heard me talk about assistance of activities of daily living, not just long-term care. But I like to talk about assistance with activities of daily living, or having care even and quality of life, even when you need assistance with activities of daily living. So some of you have seen this before, some of you haven't. This is a friend of mine who lives in New Jersey. She and her husband, when they were 50, they got their long-term care policies. They did not have children. They were teachers, so they had modest income, but they were smart with their money, as most teachers are. When they were 50, they got their policy. Her husband, Alan, died a couple years ago. In this picture, Anna is 74. She is on claim, okay? This is long-term care insurance working. She's on claim for arthritis. She took the auto train from New Jersey to Florida to go sport fishing and hog hunting. And the young man on the right is her home health aide. His name is Tyler. And her policy pays him $450 a day to travel with her. Now, she does need assistance with activities of daily living. She needs help cooking, getting dressed. She needs help ambulating from the house to the truck to the boat. But my point is this, that we need to really open up our clients' minds that, yeah, we're going to live a long time, but we just might need help, and it may not be something that our kids can help us with. And so really focus on quality of life, not just end of life, doom and gloom. So I'm going to close with some of the things I share with my clients when I deliver my policies.
Lori?
Yep.
I don't know if you, hello, everybody. My name is Mike Barilla. Lori invited me. I guess Lori, it's been now, what, probably 4 or 5 years that we've known each other. So I'm a certified financial planner, as well as being licensed 215 and all that rest of that good stuff. But to answer the question about the annuity and the IRA is the type of umbrella. That's the account type. An annuity can go underneath that umbrella. So the answer to that question is you could absolutely put an annuity into an IRA. Now, there's some redundancy there because the annuities grow tax deferred and so does the IRA, but you can still do that. The other issue you'd have there, which isn't really an issue, but that asset would also count towards required minimum distribution whenever that person hits that age. So whether it's 73 or 75, as the laws are changing, you'd have to include that annuity as a part of their assets. Now, if they're pulling assets out for long-term care purposes, of course, that would count towards that required minimum distribution as well. So, but you could absolutely do that, just to clarify for everybody.
Well, Michael, I'm going to jump in and correct you, okay? You are correct, and that's how you can hold an annuity. But a lot of the insurance companies that have those annuities with long-term care extension do not allow it to be held in an IRA.
Well, but again, that's the particular product from that particular company.
Right, and that's what I was asking, because I think a lot of them don't.
Yeah,
so Sharon,
there may be some that don't, but some of them do. But
check with One America, they do. So,
yeah. Let me go ahead and finish, and then we can talk probably off camera if that's okay. So some of the highlights that when I deliver a policy, obviously we talk about keep protecting money, that insurance companies don't just protect lives, but they protect money. I always make sure that my clients have their estate documents in place, because so many people don't, even in their 50s, 60s, 70s. So make sure that you're the one that's prodding them to get that done. Obviously, talk about the long-term care plan and include a policy in that plan. Talk to a Social Security expert. Andy posted something on our Facebook group a couple of weeks ago, and I think Kevin said he's doing the class on becoming a Social Security expert in terms of timing of benefits. That's something else we can put in our toolbox to help people to get that certification. There's a lot of notary fraud. So find ways to protect your equity from being transferred out from under your nose. Freeze your credit with all 3 credit bureaus so somebody can't steal your identity. Oh, this picture, this guy on with the surfboard, that's my frosting. Another one, don't put your adult children on your bank accounts. My background's in litigation, did it for 30 years. If you get sued and your kid's on your bank account, your assets could become part of a litigation. So tell your clients, have them get the power of attorney. Don't just have the accounts jointly named. Keep your legal documents in a safe vault, electronic. Don't just throw your policies in a drawer. Keep your passwords and electronic accounts. Give somebody else access so that you don't go into a coma and everyone's locked out of being able to help you. And don't delay. And the new study, okay, I'm going to end with this. New study results since COVID. So if you were at the convention, you'll know Mark said that 54.6% of, does anyone know the answer? Come on, Mark.
I know the answer, but I want
you know the answer. 54.6% of all statistics are wrong. But this next statistic is 100% of all of us, and this is new since COVID, are going to die.
That's right, 100% are going to die.
All right, so talk to your clients about life insurance. Be a resource, be relational rather than transactional. Build and grow your business. Thank you for letting me share.
Thank you for sharing that. That was excellent. I saw the variation. Michael, thank you for joining us. I know that I'm glad Lori invited you, to Sharon and to you and to the rest of you on the call. I can promise you one thing. If you put money into any one of these equity index annuities with a long-term care rider, if the money comes out as a long-term care expense, it's 100% tax-free. So again, it's how you use these tools and these instruments that will determine all that. We have solutions for all those things. You can ask those questions. Who has questions for Lori and what she just did? Anyone? We did record this. I will share it as soon as I get the link. Again, the woman that many of you knew who did come to the conference, Priscilla, took a new position yesterday. She's going back to school full time. So she's the one that usually posts these things. So I'm going to have to find out who's going to get me the link, but I'll get it to you. And you'll be able to watch this over and over again and take the portions you like. Michael, you had something else you wanted to add? No? Okay. I'm glad we have
Lori,
visuals of you there, Michael.
I got a quick question. I mean,
Yeah.
when you do the spreadsheet of everything, do the people get overly confused?
Who's asking? I can't see.
Scott Fishkin.
It's
Scott
Scott.
Fishkin.
Hi, Scott. Yeah, you've been my husband in role playing before, so I was like, hey, hubby. No, they don't get confused. I break it down because what I do is I tell them this is going to look confusing, but what we're going to focus on is the monthly premium, the benefit pool, and the cost.
Okay.
So that helps them eat the elephant one bite at a time. And from there, we talk about the features, but that's how I show it, is the monthly benefit, the benefit pool, and the cost. Now I tell them, if your benefit is $10,000 a month and your cost of care is 12, you still got some self-funding going on, right? So you got to show up with 12,000, you've got to show up with $2,000 to make up the difference. On the other hand, if your benefit is $10,000 a month and your cost of care is $8,000, if you've got an Aetna or Manhattan Life, you've got another $2,000 in your bank account, right? Because they're going to give you the full daily rate, but that extra money is there in your benefit pool for future care. So I think by the time we're done, I show them the worksheet only. And again, that looked a little cluttered because it had some things on there that most people aren't eligible for or are not available in some places. And what I tell them too, Scott, is I say, look, we're here today to figure out what we don't want. And frequently they'll figure out that they don't want the nationwide. They don't want the One America because they don't want to pay for the life insurance part of it. So then we've gotten rid of those. So we kind of get rid of what we don't want, and then we start to focus on what we do. But I'll tell you this, when I just show somebody a premium that's $300 a month, that's a lot of money, right? Until they look and see that the other options are $600 or $700 a month. And then they're like, oh, 300 is not so bad. So.
Okay,
That's
so
right.
excellent job, Laura. I know I'm going to go back and rewatch it, and you've done a good job consolidating stuff that you've shared with us before. And yes, Lori, again, I apologize for what's been going on with me health-wise, getting in the way of some of my uh, introductions of the great people you had in front of you today. But Lori did share with me that she did sell a $820,000, or about to sell an $820,000 fixed index annuity with an LTC rider. So again, Lori, that's the second week in a row, or the second time since we've had these calls that you reported doing an equity index solution. What all of a sudden?
I've been doing it for a long time, Mark. I just haven't been focused on that recently because I've been so focused on the Medicare and the long-term care strategies. And it's not my first play. It's definitely not. I completely, like I said, I don't even bring it up, just that it's an option. I don't show them options, but it's really driven by the people that, and it's not 1-800,000. It's 200 and 200. It's several added together.
Okay.
But I let them say, I'd like to see that. And then we look at it, and if it makes sense to them, it's none of my business what they pick. If they decide to self-fund, I tell them that. If you walk away from this conversation and you've decided you're going to protect this risk out of your own money, I've done my job. On the other hand, if you want my help, we're going to figure out what makes the most sense for you. And if they come back to me and say, I want to see what this looks like, because I've been doing it long enough, it doesn't scare me to do it and talk about it. Now, I'm not a certified financial planner like Mike, but I have resources to walk me through if I've got questions. The carriers are great. So
yeah, but
the
fact that you do it that way is so impactful. I'm sorry, who's that, Scott?
Yeah, sorry about that. Which index annuity are you using?
Equitrust has an FIA that's got a lifetime income benefit rider that the long-term care for chronic illness, there's no charge. And North American also has one that seems to be ill. I have a team that does the back work for me to tell me how they all compare side by side, and so that I make sure I'm always on the edge of the game in terms of knowing what's performing the best. And so.
But again, people like Claude can help you with that too, Scott. They can help you decide which one's the best course to take, and Back9 has a lot more fixed annuity products than we do at NAS. So you can use that as a point of reference to help you determine the best product.
And Scott, I'll tell you this too, is that I need, Dave Ramsey does not believe in annuities, and he doesn't believe in hybrids. So I don't talk about those a lot, except to say that these are some of your options. And in the case of the hybrid, the reason he doesn't like them is because you are paying for life insurance when you shouldn't need it at this point. Now, not everybody is in that place, but what I say is One America has an asset care that will give you a lifetime benefit. To me, if someone's got longevity in their life, regardless of what you're paying for the life insurance, if you know you're going to go on claim when you're 82 and live till you're 98, there's no way that you're not going to get way more money on a lifetime benefit than you ever put into it, especially because it has waiver of premiums. So you're going to stop paying your premiums when you go on claim. So there are appropriate solutions for different scenarios. And it's none of my business what my people pick. I just have to show them what's available.
Yeah.
Hey, Lori.
She's right about that. Go ahead. Check.
Lori, did you do the slides yourself, or did you pay someone to do them? Because can I pay someone to do it?
I paid myself. If time is money, I probably
that's why.
Me 4 hours.
Okay.
No,
I liked your theme of surfing and beaches, and because you started out with the line, if you stick your head in the sand, then something about, what was it? Stick your head in the sand, yeah.
Sharon, the slides, almost every one of the slides are the slides I use for my interviews.
Yeah,
Obviously,
I
not the ones,
I
not the ones
recognize it.
speaking to agents, but the ones that talk about protecting the risk.
I know,
recognize
I
the
just don't
slides.
want to put the time in like you did. I don't have the skills to go in and do all that, and it takes so much of my time. So I thought if you paid someone to do it, I want their name, I'm going to go pay someone. I'd have to pay you though, huh?
I'll share what I got.
Okay, Sharon, you follow up with her if that's really what you want to do. But again, it's always better when you take ownership of the slides. So, like, you decide
Yeah,
what's the
it
best
is
route for
helpful when
you.
you make it your own. I mean, my slides have evolved over the years, so they're not like they were when I first started, but
Okay, so are you seeing the slide with Mark's picture on it again?
yep.
Okay, so that worked. So let me go to the slideshow. And I'm going to let you guys go because I'm not going to keep you with all the things that we need to share. I just want you to think about why you need to be here. You saw why you needed to be here this week. Lori just demonstrated that to you. I am going to set up something separate with Mark um, because I think that Lincoln Money Guard is really making a fresh attempt at trying to win over a higher percentage of the marketplace. So we should be up to speed on that stuff. Everybody look quickly at this list. I have a handful of leads from these states. If you're in any one of these states, be the first one to send me an email saying you'd be interested in it, and we'll go first come, first serve for this purpose, and I will send you that lead. Um, so again, there's no commission split or any kind of thing like that with these leads. This is leads we have left over from a program, or not left over, but just recently generated from a program, and we're going to share them at no cost to you. So let me know. This is what next week's going to be about, real quick. It's funny that the Lincoln Money Guard people talked about their asset finder. That, in effect, is nothing more than a fact finder. And when I started out in long-term care in 1991, we had what we called an interview profile form. Well, Steve Weinberger and I have been working together jointly to put together a new version of that. And the whole purpose of it is to help you bundle more products. And so next week, we're going to look to introduce you to that. So that's one of the reasons I want to make sure you're on the call with us. Wellaby is going to be our guest speaker next week. Wellaby has a letter. I could show it to you now, but I would have to come out of the program to do it and just tease it for next week. That they've tested already, where they'll help subsidize and pay for a mail campaign to your clients about their extended care product. And again, this has proven through their own affiliated agents to be successful. So this is exclusive just to those agents that are appointed through us at NAIS, but you're going to get an introduction to that program. We're working on several other programs as well. There's a program out there that talks about Medicare Advantage and how it can be made available to the veterans. The woman called while we were talking, and I've got to get back with her. I don't think I'll have that ready for next week, but I'll have more information on it, and that's another reason to be there. And there's so many other things in the works as well. So I'm not going to keep you on talking now, except to say, please try to be here again next week to find out all this information, because again, all this stuff that we're negotiating is exclusively because you're part of what we're doing here at any IS, and I want you to, be able to take full advantage of these opportunities while they are being made. The offers are being made directly and specifically to you. All right, and one last thing, I guess, as I go, I like many of you, I guess, I've been watching some of the Olympics, and it can't help but occur to me that there's one common denominator amongst all these people and all these great performances you keep seeing in all these competitions. They focus on the baby steps, the little things, and it takes them years. Can you imagine preparing for 3 or 4 years and then having some of the things that you've seen happen in these Olympics happen to you? You miss qualifying for a medal by 1/100th of a second. I mean, and you have to carry that for years before you get to try to do it again. It's the little things that make all the difference in the bigger picture of things. And so we'll talk more about that in the weeks ahead, but don't lose the lessons of the Olympics as it applies to our profession, because there's lots of stuff there. And you and yourself are a long-term care solutions athlete. So we'll talk about how we can take the lessons from that and apply it to our profession or to our practice and build a better business. All right. Anybody have any other questions on anything? Don't let the dog days of summer get you down or get you out of your momentum. Again, one of the reasons why I want to bring this program to you next week from Wellaby is that there's absolutely no reason why August can't be one of your best months if you take advantage of what these carriers are willing to do to help you grow your practice at a time when their businesses are a little slower too. So when they're willing to put up money and help you, you got to jump in and take full advantage of that, and you can shine while everybody else is just trying to break even. All right. Again, Lori, thank you. We appreciated everything
Thank
you
you.
shared. All right. And look for the recording and all the lots of links from the carriers too. I'll send that out to you with the recording link in the next couple hours. Until then, everybody, good interviewing.
Thank you.
Bye. Thanks,
Take
Mark.
care.